Here's advice you've heard 100 times. To win at investing, you must pick the right stocks. It sounds smart. It is mostly wrong. Quick, honest note first. This is education, not advice. Believing that myth can quietly cost you money. Let me show you what actually works instead. Most beginners are never told the simplest part. You don't have to pick anything at all. One tool buys a little of almost everything. It's called an index fund. An index is just a list of companies. The S&P 500 is one famous list, roughly the 500 biggest companies in America. An index fund quietly buys all of them. Buy one single share of the fund, and you own a sliver of every company on it, all at once. No guessing required. You're not trying to find one needle in a haystack. You're buying the whole haystack, needle included. No crystal ball, no stock picking skill needed. And beating the market means topping that entire list. Sounds doable. For most people, it just isn't. Think of it like a fruit basket. Picking stocks is betting on one single fruit. Maybe you're right. Maybe it rots. An index fund buys the whole basket instead. If one fruit spoils, the rest still feed you. You stop betting on one and own the harvest. But why bet on the whole market at all? Because you're really betting on the economy itself. Over decades, companies overall tend to grow and earn more. Some die, and new ones replace them on the list. The index swaps losers for winners for you, automatically. History rewarded that patience, though it's never guaranteed. Now meet Maria, 25, just opened an account. She doesn't know a single stock to buy. With an index fund, she simply doesn't need to. She buys one fund holding the whole market. $200 a month on autopilot. That steady monthly buying has a name. It's called dollar cost averaging. Some months prices are high, some are low. Maria keeps buying and averages out over time. No trying to time the one perfect moment. Keep Maria in mind. We'll come back to her. Now the part that quietly does the work. Cost. A stock picking fund hires expensive managers. You pay them a fee every single year. That yearly fee has a name, the expense ratio. It's the slice the fund keeps from your money yearly. An index fund just copies the list. No star manager, so its fee is tiny. A fee is the one part of investing you control. You can't control the market. You can control costs. That's why the smartest investors obsess over fees. That gap sounds small. Watch what it does. Let's walk through it with real numbers. Say you invest $10,000. Fund A, an active fund, charging 1% a year. Fund B, an index fund, charging 0.04%. Same money, same market, only the fee differs. 1% means $100 per $10,000. 0.04% means about $4. $96 of difference in year one alone. Feels trivial? Here's the trap. That fee hits every year on a growing balance. 10 years in, the gap is already obvious. 20 years in, it genuinely stings. Over 30 years, that small leak compounds. It can cost tens of thousands in lost growth. Not on the fees alone, on the growth they prevented. Picture it. That gap could top $20,000. Enough for a car or a year of living costs. Small percentages, long time. That's where fortunes leak. All quietly lost to a fee you barely noticed. You paid more, to a professional, to often do worse. Here's what the glossy ads leave out. Stock picking funds are sold as the premium choice, the smart money option, the experts. But measure them over 10 or 20 years, most fail to beat a plain index fund. Once you subtract their fees, the majority trail. Only a small share of pros win over the long run. And picking that rare winner in advance? Nearly impossible. Most pros lose to the boring basket. Pause on that for a second. You pay a premium for a worse result, on average. The ad shows the dream. The data shows the drag. The side charging the fees rarely advertises that. So here's the mistake beginners make. They chase last year's top-performing fund. It won big, so it must keep winning, right? But past performance doesn't predict the future. This year's star is often next year's straggler. Chasing winners means buying high and bleeding fees. Here's a quiet irony worth knowing. Many active investors don't even match the market. They trade too much, chase too much, pay too much. Why does any of this matter for you specifically? Remember Maria and her boring index fund? Her money grows on what she keeps, not what she picks. A 1% fee doesn't sound like a villain, but over a whole career, it eats years of returns. Maria's tiny fee quietly leaves her with more. Years later, Maria never beat the market. She just kept more of what the market gave. No genius required, just low cost and patience. Not exciting, just effective. So how would Maria actually buy one? Through a regular brokerage account. Many charge nothing at all to trade now. She searches for a low-cost index fund, or ETF. First, she checks one number, the expense ratio. Lower is better, all else equal. Then she checks what the fund actually tracks. The whole US market? The S&P 500? The world? Different lists, different risks, same simple idea. She sets it to invest automatically each month. Then she mostly leaves it alone for years. Boring on purpose. That is the strategy. Now, the caveat most index fund fans skip. Diversified is not the same as safe. An index fund still falls in a bad year. 20 or 30% drops have happened before, and they will happen again. You own the whole list, including the losers. A popular index leans hard on its biggest companies. You're less spread out than everything suggests. And not every index fund is actually cheap. Some charge high fees for the very same list. So always read the expense ratio before you buy. Cheap and broad? Yes. Bulletproof? No. Anyone selling it as risk-free is selling a story. And you don't need a lot of money to start. Many funds let you begin with very little. So the verdict on our myth: you do not need to pick winners to win. For most people, owning the whole list cheaply has been the genuinely hard thing to beat. Not because it's clever, because it's cheap and patient. The fancy fees usually just can't outrun it. So the smartest move is often the cheapest one. You walked in sure you had to beat the market. Walking out a little less sure? That's good. That healthy doubt beats any hot stock tip. We bust one money myth like this every week. Next time someone says, just pick winners, you'll know.